overseas strategies. And to tie it all together, Han will explore the transformative cross-industry AI opportunities that we're capitalizing on. Before we start, a quick housekeeping note. To make the most out of our morning sessions, we have forego a formal coffee break. However, the refreshments are available in the back of the room, so please feel free to help yourself anytime. This afternoon, after the lunch break, the focus will shift to our fund performances. Our team will provide a comprehensive fund-by-fund performance review, taking you a closer look at our results. We have designed today's program to be a comprehensive and efficient review of our strategy and performance, and we expect to conclude the AGM at around 3:30 p.m. With that, it's my pleasure to invite to our stage our CEO. Please join me in giving me a warm welcome to Stephen.
Welcome, and every year we meet together, not only to report our activity, but put me into a test and back into this old suit, see whether I can fit in. So this morning I do squeeze myself in this one. And 12 years already passed, and this is in fact the same suit I put on 12 years ago on the roadshow to raise first fund. And a deep thanks to everyone and to support us to go through all these journeys and experiences. And quite a journey for the last 12 months. Last year, everybody very pessimistic about China. In fact, in 2023 and 24, many GPs left China. And marvelously, this year, Chinese market rebound significantly. So today, I will cover four topics. One is what we have achieved in the last 12 months. Second, what is our traits? What is our DNA for the HLC team? Third, what is our view for the future? And fourth, what we plan to do. In fact, it is about value, personal value, world value. So let's go into what we have achieved. Fundraising-wise, we closed two new renminbi funds, in total $112 million, and our AUM increased by $294 million across different renminbi funds and the US dollar fund. And then investment-wise, we continue to deploy capital into the market. In the last 12 months, we deployed $189 million, and roughly even between renminbi and US dollar fund. US dollar fund is about 90 million, renminbi fund is about 99 million. Exit-wise, as you know, we all focus on exit, and on renminbi and both US dollars, we achieved a decent progress on exit. On cash return and liquid share-wise, in total we increased $526 million. And on the US side, we increased $389 million. I will go into details later on all these numbers. And organization-wise, in total number, zero change. We added 4 people, we let go 4 people. So in total, we keep the flat organization. Fundraising, I'm happy to report, we closed renminbi fund $800 million, 800 million renminbi, roughly $112 million US dollar in October. This fund will cover early stage biotech and growth stage wellness, consumer wellness and manufacturing. And the renminbi fund will help us, especially the US side, to increase our deal coverage and regional coverage into China. In progress, we are raising $1 billion renminbi, which will be based in Hangzhou, focus on early stage biotech and AI. So this, again, with the increased AI exposure, will help HLC US dollar fund to increase deal flow in this exciting new arena and new opportunities. Fund 5 US dollar is in planning, and we will talk about the fundraising activity later. Investment side, as I mentioned, we invest about $90 million in the last 12 months, and it is spread across different sectors, different stage, and different region by strategy. So all these things is by design, is top-down, and we ask each sector team and each regional team to strive for their best to select deals, for IC to make choice. So the result is in China we deployed 67 million in the last 12 months, and overseas 23. Growth stage is still the bulk of HLC investment, 52 million, and VC stage is 38 million. And we gradually increase the VC stage allocation to make sure in the end of the day, the total portfolio is about 30% in VC. And also by sector-wise, you can see is quite balanced investment. Same thing for exit. US dollar funds, cash return and liquid share improvement after 12 months remains strong and consistent. And the cash return, we returned $112 million US dollars. Since 2020, every year we return more cash than we invest. Remember, we invested $90 million last 12 months, and we returned $112 million last 12 months. So that has been a discipline for our team. Our team worked very hard to try to return much more cash than we spent. And then liquid share-wise, it shows $277 million increase in the liquid share by 5 new listings in the market. So that's given us $389 million increase in the cash and liquid share, which is very important for future cash return. And across funds, as you can see, Fund 1 is already at the end of their journey, so it's shown a little bit increase in cash. And Fund 2 and Fund 3 is in their full speed of exit, so it shows much more, cash and liquid share improvement. Once again, it's also across different sector and theme. It shows a balanced, performance. Organization-wise, we gained 63 awards from overseas organization and the domestic organization. And team-wise, as I mentioned, is flat, 49, +4, -4. And I want to go into a little bit of detail on promotion. We have 6 promotions. Most notably is Henry promotion to CIO. And Henry achieved 8 IPO so far, and also demonstrated a strong leadership and loyalty to the platform. Gained wide respect among the team and LP and entrepreneur. So his promotion is well deserved. And also there are 5 other people's promotion. You can see we weighted on young leaders. We try to help these 32 years old young deal leaders to grow further in our platform. That's one message. And the other message is people like Tina, Linhan, Austin, and they are all technology driven by either AI tech, they're all tech driven. So in the future, our talent policy will be tailored to cultivate young talents on our platform. More importantly, weighted on the technology-driven people. And also, we have 3 additions. Sherry is a returnee. She joined HLC in 2001 and left briefly for 1 year for multinational work, and then returned last year. And then Edward and Wilson is a new addition. They, in this addition, you also see 2 biotech talents. Same message, more talent oriented to technology-driven deals. The departure is 1 in the deal team, Associate Director, Medical Device. In the later reports, you can see we allocated more on the AI-related device than traditional medical device. So, and then back office, we have 1 person changed to part-time advisor, and 2 individuals we restructured. So, in summary, this is a team take a very steady and sure step forward, and we think 1 step at a time wins the race. So this is the number summary I described in previous slides. I'm not going to go through it again. So next part is what's our trade. It has been 12 years after we founded this firm, and we achieved many milestones. So going back, we experienced a different market, a different policy, and even different situations. So what make our team sustainable and can consistently deliver results? So I reflected what is our DNA, what is our traits, bottom down, basically who are we, what we believe. So it came back to me 4 top ones. Bear with my English capability. I always think about Chinese and try to translate it into English, so I keep the Chinese here. I think Chinese is more profound than English terms in my capability. I often also ask the AI help. I found out it's not helpful, so it's not easy to translate Chinese into English. So optimistic, spirit, engaged. I found our team, everyone on our team, very optimistic. Either is facing challenge or difficulties. They always put a smile on their face and continue on. So even in 23, 24, you can remember how bad the sentiment is about China. We keep going. In 23 and 24, we keep investment space and put money into the Chinese market. One important example is home gym. Henry and I keep engaging in home gym in 23 when nobody looked at this market. And then in early 24, an opportunity showed up because one of the investors feels so bad about market, they decided to get out from this deal at a very low interest rate, basically a redemption rate. So we stepped in, we put $40 million into this deal. It's quite a big check for us. And the firm, the valuation is $1.6 billion, represent 56% down from the B round in 21. And then subsequently, the firm achieved good results. For example, last year, the net income is $104 million, and it has $0.6 million in cash. So basically, we bought a company at $1.6 billion with $0.6 billion cash, and with $104 million in profit. So this opportunity doesn't show in today's environment, but it will show in a very down market. The second one is this team showed a very steady and unwavering core to deliver. So when we face music, when we face good news, we are not arrogant. We are not, so that happy. We keep our cool heads. And when we face difficulty and challenge, we always bear our heads down and keep going. So if you go back to the time in 21 and most of the time in 22, the market is great. The stock market is bouncing around. So we took the opportunity to get out from certain listed companies and get back over $400 million cash back to our LPs. So when we see the market is hot, we are always the guy on the sell. So it is our kind of DNA. Myself, Henry, and Aaron, and Eric are all kinds of people. So when we see somebody is so happy, we become cautious. When we see the market is down, we say, oh, there's an opportunity out there. Being a contrarian in heart is very hard because you don't have many friends. You're the weird guy, you're the weird kids in the room, right? So starting from the last quarter or third quarter in 22, the market become very pessimistic. So what do? We push redemption and M&A because the IPO market is not viable. The stock price is down. So during that time, we returned $155 million. Most of them came from redemption and M&A. So when the market is down, it's not easy for us to IPO. It's not easy for us to sell the shares. What do? We push for other means to get money out. So fast forward to these days, the market rebounded, the IPO market is reopened. So we pushed our portfolio companies to IPO. So far this year, we have 5 listed companies out of the US dollar fund, and 5 another one already filed. So all these activities, how these activities happen, how this result happens is because it's DNA. This DNA is very fundamental to our team. Certainly, this is a team trying to explore new things, just like the chair I read out. Last year, I cannot show you this kind of deals because our team is still working on those things and themes. And this year, we have 3 or 4 very cool AI-enabled home wellness product we can show to you guys. So this journey is not a short journey. We in fact believe AI will impact our life fundamentally in 2022. So we quietly assembled the team and began research. So far, we have invested over 400 AI-related deals, and the first investment started in Renminbi Fund in 2022. And with the success in Renminbi Fund, we ventured into US dollar investment in 24. And so far, we have 8 deals in US dollar deals, 3 upstream and 5 downstream. This pattern copies our healthcare investment. As you can remember, our healthcare is very heavy on CRO and CDMO, which is upstream, and also very heavy on biotech, which is downstream. Same thing, we think as China grows, as our capability and capacity grows, our entrepreneurs have the desire to go overseas to explore new frontier. We have to go with them. So we began our overseas journey. And so far, we built a lot of synergies across borders to help the small, medium-sized enterprises to gain synergies cross border. The fourth fundamental DNA of our team is we work together. This is a team with a culture all for one and one for all. And I worked in many other institutions before. I found out team culture is quite different. In many situations at work, when I engage into a deal, I'm very happy outside to talk to the entrepreneurs, to work with external partners. But when I return to my own firm, I feel stressed, I feel confused, because I know they're not my people. There are people in my firm who work against me. So I always have trouble, to internal. So when we founded this firm, we decided that this is the fundamental DNA I want to instill in everybody into our team. So we are together. We need to work together. Yes, you need to think about your self-interest, but I think the team interest should be before the self-interest. And with the stronger team and better team, everybody will enjoy. So we work together. You can ask each of us, and they will tell you their story, how other people will help the individual grow, how other leaders will step outside their comfort zone or their sector to provide help to the individual growth. So that's our kind of DNA, basically who we are, bottomed up. And for this, I want to thank all the teams and LPs. I enjoy this journey quite hard. It's 12 years, it's hard working, a lot of happiness, a lot of hardship, a lot of difficulties, a lot of achievements. But when the time passed, I truly don't remember those IPOs and those deals that clearly. But in my memory, I always remember this moment I spent with my team, these outstanding individuals. We go through many different locations. So if there's an award in China, the best outing GPs, and I'm sure we're number one. Very hardcore outings. I just give you an example. In 2019, on the Spain hiking trail, 5 days, 7 a.m. to 6 p.m. every day, 5 days continued. Every day, around 30 kilometers in the mountain. So that's not many GPs will do that with the entire team. I was amazed. Some of the back office mummies, they are quiet. They deliver their work and very humbly. They don't speak loud. I worry about them. They're mummies. They have 2 kids. They're not feed us hungry. After all these trail days, in the evening, I'm tired, so I was lay down and sleep. Henry, Aaron, and other boys, they will go out to run. They said, after dinner, still feel energy. They will have 2 miles run. So those mommies truly impressed me. Now Henry, Henry, they're troopers. So those are the moments I remember. So for that, I thank you all for the support and and other LP for the money. And that's your money, right? That's the management fee. And we enjoy this moment. And I think that's probably more important than deals and results. And deals and results are the fundamental, which is more important, life-wise. So we talk about what we have achieved and who we are. So let's talk about the world and our view about the world. Because I need to go back to China, I cannot talk too much on this topic, but very publicly, privately, we can talk more, but publicly, let me touch on the top things. And many of you know since 2019, I lead this firm for 5 years. At that time, I began to read a lot about history, both China and worldwide. So that's gave me good kind of grasp on the view of the world and how the megatrend will go. And that's more important than our daily life, than our daily endeavor and this deal and that deal. If we gauge that trend right, more or less will be good. If we got that trend wrong, it doesn't matter how hard we work, it will be wrong. So what's our view? Let's go back our AGMs. We talked about this in the so-called dark days in the last several years. In 22, when China was locked down, we talked about what kind of world we are facing. Our conclusion is we will heading towards a regionalized world, led by two largest global power. Competition will be long and fierce. So that's our 21 view on the situation. And on the other hand, we think about the China's strengths. We think this country and these people has unique strengths in six dimensions: resources, labor force, infrastructure, science, technology, virtues, and culture. And fundamentally, we believe in China and the Chinese people's capability and the character. And then the situation continued to be bad. So we think about what do we need to talk to you about. And we go back to China. We think about why after 2,000 years hardship, foreign invasion, why this country always rebound, why this country always came back to the world arena, become a player. And I think because they're heroes. There are many Chinese people in their hearts, they are heroes, included the people sitting here today. Maybe you're a small hero for your family, right? You're fighting for your wife's wish or your kids' dream, but you're heroes for your family. Or maybe you become a bigger hero for your organization, for your team, or bigger one for the society or for the country, but always there are heroes arising in China, helping this country and people moving forward. So that gives us strength and belief. Even in the darkest days, people are so pessimistic about China's future. We are here. We believe in China. We think sooner or later there will be heroes out there, turn the things around. So that's our last two AGM's message. Fast forward to today, with all this information, things came in. So what we found out is it is a truly changing world order, and two superpowers decoupling to an emerging modus vivendi. So if you don't know this term, Google it. This term is almost it's a precise term describes many families. So after 20 years marriage, wife and husband is modus vivendi. So for the people who married many years, check this word, you understand what I mean. And trade-wise, you can see both countries decrease their trade. So before the trade war in 2018, U.S., China, each other traded between 14-15% of their total trade cross. So in China, basically 15% of Chinese trade is towards U.S. Right? Today, this number dropped to 10%. On the U.S. side, it dropped from 14% to 9%. So China always export more than U.S. import to us. So there's always a surplus, but the percentage decrease. And you ask me, you travel to China, you travel to U.S., so what? Both sides, people still living a good life. There's not much changes in the personal life, right? I still buying new cars, buying new homes, so that's the status quo, and that's an equilibrium. We don't think it should be so concerned in a person. Capital-wise also decreased. So Chinese holdings of U.S. Treasury bond, the Chinese government actively diversified from U.S. Treasury holding to European bonds and gold. So This is a steady and surely steps the Chinese government taking. And people-wise, it's a huge job. And to be honest, since 2019, I haven't traveled to US at all. And I asked myself, so what? I know the most frontier technology of US by reading all the reports. And my biotech team traveled to US, they bring back the insights, and through partnership and the CRO referral, we continue to invest into US deals. So this decoupling is happening, and I think gradually it's reaching an equilibrium status. On the China side, I think we see resilience. Chinese economy is resilient, and then the country showed a strong status to be the only guy standing on the block facing this big dude called the US. None other country in this world will facing US whole front, right? From military, economy, trade, technology, all this perspective. This is the only country will facing US whole front. And all these numbers here, I will not go into details. On the policy side, last year we do see heroes in China turn the things around. They are quietly and surely and put out policies to support business, to support growth, to support private sector. So that's quite assuring for me. Going forward, it is our view on the world. I think this competition is quite different from previous ones. If you put US-USSR competition and the US-Japan competition in comparison with US-China comparison, it's quite different. Only from the sheer size of population volume, you see the difference, right? USSR has 140 million people, and Japan has 125 million, and this country has a 1.4 billion. So when this size of country decided to stand up, it has a big chance to stand up. So if any of you are interested, we can talk about it in details, how Japan and USSR failed, and what lesson the Chinese top elites learned from their failure, and began to put into policies to help China in this competition. The history is a really good teacher. It teaches about, you guys may not know, there's a top institution in the central government in China who studied these two competition thoroughly, and they reported to every president of China on these two competitions, the USSR competition and the US-Japan competition, what USSR and the Japan failed to do and should do to be a better competitor. So I have the luxury, in fact my wife has the luxury to be part of that institution, and I secretly read some of the reports, and I know there's really smart, outstanding people out there in the top. I understand all this. So the new equilibrium, I think, will be reached because of both countries has great heroes and battle-tested systems. And Chinese system, like it or not, it is a reality. Maybe you and I will complain this or that part of the Chinese system, the whole system, but it is a reality. It is not a vacuum reality built on the air, built on some people's wish. It is a reality built on long-term history and the battle-tested, experiences. So. In summary, I think China will become a national capitalist system, very top-down, long-term planning, and built on collective efforts. So one entrepreneur or investor want to work in China better, you've got to understand their top strategy and top-down planning. You got to follow that, and you got to think about your effort, what your effort means to the collective interest, to the benefit of the entire people and the country. So if you follow that, you will be thriving and making money in China. If you don't follow that, you will get hurt. And in contrary, in US, it's a totally free market. It's a wild, circuit, and anybody can do anything. Like Elon Musk, he can push the board to give him $1 trillion reward. Those kind of markets. So this is a two different systems competing, and we are very lucky. Since I'm an optimistic guy, so I'm very lucky to be in this area to witness the history making. So in 10 years, in 20 years, in 30 years, we will meet again, and we will see the result of this competition. This is a century competition, and it's a wonderful competition. A lot of things will happen. It makes our life exciting, right? You wake up in the morning, something happens. It's not boring anymore. So besides this geopolitical megatrend we talked about, and there are two megatrends I want to touch a little bit on, and which I think everybody has a sense. One is technology. I think the progress of AI, the progress of biotech, the progress of quantum computing will change our life, will change how we work and how we live in the 10-year, 20-year, 30-year time frame. So that's another exciting moment, right? Just like this, I can talk to this wheelchair and it will bring me on the stair. I can envision in the future, truly I may live to 120 years old. With my team's effort, all these artificial hearts, all these drugs, all this diagnostic. So let's embrace that area. So this technology will change our life. And the other thing is aging. With technology, you will live better, will live longer, and we enjoy our life quite a bit. So the result is not many young people want to get married and want to have kids. So our major economy and major countries will have decreasing population in the next 10, 20, 30 years. That's something we'll have to face. So if you're a big house owner, you have 100 apartments worldwide, bad news for you. If you are here, you're a healthcare investor, it might be a good news for you. So the old Steven will continue using your drug and buying wheelchairs until he is 120 years old, try to live to 121. So that's two other megatrends I want to talk about. So with that, we talk about what we have achieved and our traits, our view on the future. So it came back to what we want to do as a small firm. So we laid out what we want to do here, and in the afternoon LPAC meeting, I will go into details of the future plan. So basically, country-wise, we want to stay focused in China. This is one of the G2. We are born here, we grew up here, we know a lot about this country in and out, we have friends here, network here, so we will be grounded here. So this is our home country, this is our home turf, we'll fight it out. And then with China's strengths, we'll try to create some cross-border synergies for small, medium-sized healthcare and wellness companies. Because those companies also want to get into China and use China's strengths, but they don't have resources. So it is our job to help them. Sector-wise, same again, we want to stay focused in healthcare because this is what we know better. We know awful lot about the healthcare, the technology, the market, the people. So this is our core competency. And building on top of that core competency. Sorry, it's English. I don't travel to US anymore. So. 山东话是比较好的。English is rusty. So building on that core competency, since AI is emerging as a mega trend, we embrace it wholeheartedly, trying to use AI as an enabling technology to help our consumer companies and healthcare companies to improve their production or provide better products. So that's sector focus, stage focus. Once again, because we're facing such a fierce competitive market, so our focus has always been growth capital. So throughout every fund, we invest over 70% in growth capital. That means lower risk. That means better visibility into exits. So we will continue doing that with a little bit of increase on the early stage due to biotech and AI technology improvements. Management and fund-wise, fund consideration. In the future, one fund will be smaller than Fund 4 to drive for DPI and better performance. And also for us, for myself and some of my team leaders, to enjoy life better. Because when you run a bigger fund, you'll have pressure down the road. So I don't want to, when I get to 65 years old, you guys knocking on my door. The door says, "Hey, Steven, where's my DPI? Came up, you owe due to return my money." I don't want that. I want, when I get to 60, 70 years old, you came to my birthday party, everybody relaxed because we already returned your cash. And team-wise, because we're facing this world with changing global order and changing technology framework, we have to bring up young people, the young talents. I'm the oldest people on my team. I'm 52. So I will touch on that later. So, Henry is 42, 41. And today, majority of our deal leaders in their 30s. So we want to maintain that. The people in their 30s will be in the driving seat, driving to the results and deliver the good deals. So I still remember when I worked for other firms, I'm in my 30s, I have much, much more energy than today. So that's and also much, much more open-minded. So that's the people we want to bring up, help them to grow on this platform. And state-wise, there's only 2 layers in our firm. Everybody is doing their own deal, and there's ICs. So there's no other tiers in between. If there's an associate on a good deal, and he or she can directly call me or Henry in the evening, Steven, I want to talk to you in 30 minutes. It's a good deal. I want your attention tomorrow and fly to Shanghai with me to meet with the founder. So that's kind of nimbleness and flexibility is what we want to maintain. So that's on top of what we want to do in the future. Next page. That's it. Somehow it's one by one. Okay, to talk about age, 18% is a small probability you, as an investor, will not bet on. But this is a statistic, this is the probability of anybody live over 80 years old. So what we try to do here is beat this odds. So for Steven and everybody here to have a better chance to live over 80 years old. And 11,315 days. It's a day on average, I will live on this earth. 83 years old is the average life expectancy for Shanghai male. Shanghai female will live to 87 today, as life expectancy. I'm 52, so that's the days, on paper, on statistics, you old Stephen will live on this earth. So what I will try to do, to lay back and retire, no fucking way. This is a wonderful world. I love doing what I do, and thank for you guys. Give me the opportunity. I like deals, like new things. I like meeting new people. I like supporting young entrepreneurs to fulfill their dream. I like my team. I like fooling around with them, go skiing, hiking with them. So I will keep going. And everything is possible. Nothing is easy. So that's my lesson so far. Either working as an investment professional, or working as a Chinese, or working as a husband, as a father, is all that. Nothing is easy, but everything is possible. So thank you again for listening to me, and thank you again for supporting my team. And later I will hand over to our CIO, Henry, to talk about the strategy and supply chain. Henry.
And also our friends from Strauss can also follow Stephen.
Thank you, Stephen, for the macro and our funnel overview. I agree that actually we are all very lucky to be a healthcare investor in HLC. With your long-term support, to be able to invest into the great companies with true innovation and entrepreneurship. We enjoy our investment, enjoy our life, and of course, we enjoy the exciting team building and funny activities here. So good morning, everyone. Nice to see you again this year in Hong Kong. So in my part, I would like to introduce HLC's overall strategy, and in the later part, our sector leaders will introduce their sector strategy and show you more cases. First, let me introduce our investment team and the deal leaders. They are the key to our success. HLC has built a seasoned and dynamic team comprising 20 deal leaders who specialize in various sectors and regions. 15 of them have been with us for over 5 years. As you may already know, HLC adheres to 3 consistent investment themes: supply chain, consumption, and innovation. Stephen and I are heading the supply chain alongside 3 talented young leaders, Aaron, Michael, and Emery. Eric, Alvin, and Shane oversee the consumption theme, working closely with Bob. Jimmy coordinates our innovation team, which includes our PhDs, Tina, Sherry, Dee, Xinqian, who bring a wealth of experience across diverse modalities and cutting-edge technologies. Across these 3 pivotal themes, we have 2 overseas offices in Seoul and Tokyo, staffed by local experts Lee, Shimizu, and Audrey. They are executing growth stage deals with potential China collaboration angles. In US and Europe, we have 4 venture partners who assist in sourcing and evaluating VC stage biotech deals, while also exploring R&D collaboration opportunities with China. Additionally, we have 3 leaders, Han, Marina, and Austin, who focus on AI plus applications across healthcare and consumer wellness to capture the evolving opportunities of the AI era To further elaborate on our investment strategies, in the next session, we will invite leaders from each sector to systematically introduce their sector strategy, approaches, and case studies. For the supply chain, including pharma and the device sectors, which mainly focus on growth stage deals and is also my key area of responsibility, I will personally present the details. In the consumer wellness sector, which also predominantly grows capital investments, Audrey will be the representative to elaborate. Regarding the biotech sector, which mainly centers on VC stage deals, Ginny is coordinating our innovation team and will take the lead in the introduction. Following that, two of our young leaders will share our team's perspective on emerging trends. Emery will discuss overseas opportunities and synergies, while Han will cover HLC's AI plus opportunities and synergies. So let's start with our first part, supply chain. HLC is strategically positioned within the pharma and the device supply chain, achieving outstanding returns through a well-structured portfolio. Over the past 11 years, we have executed 40 deals with a total investment of $580 million. 13 of these companies have achieved IPOs. Our performance speaks for itself, with more than 2 times MOC and over 1 times DPI. Our investment strategy centers on 2 main themes. The first is high-value manufacturing, leveraging China's edge. We believe in the immense potential of China's manufacturing capabilities and have invested in companies that excel in this space. The second theme is core product growth, where we focus on pursuing scalable growth opportunities. Looking at our pharma and the device supply chain, we have built a diverse and robust portfolio ecosystems. Within the pharma supply chain, we have invested in top-tier CROs like Pharmaron, Viva, and TriApex, as well as prominent CDMOs such as Hongjin and Brightgene, along with specialty formulation manufacturer Novast. Our investments also extend to upstream core materials firms, including Lapure and A-Biocap. In the device supply chain, we are proud investors in Myri, China's largest device company, as well as other industry leaders like Weigao Blood, Xilex, and Safri. Furthermore, we are actively expanding our reach to an increasing number of AI plus components providers, including Tongya and Foley. We are confident that our strategic positioning and a well-structured portfolio will continue to drive exceptional returns in the future. Moving on to our next slide, HLC supply chain serves as a cornerstone investment in each of our funds, driving sustainable returns through key strategic deals. Our focus on this sector has enabled us to secure sizable winners over the long term. Let's take a closer look at each fund. Starting with Fund 1. Within the pharma supply chain, we have invested Pharmaron, China's leading CRDMO, with a market cap of $8 billion. In the device supply chain, we have captured Myri, China's top medical equipment provider, with $36 billion market cap. Our total supply chain investment in Fund 1 amounts to $84 million across 10 deals, representing half of the fund. We have successfully navigated 5 IPOs, delivering robust DPI performance. The DPI plus liquid share stands at around 360% of the sector investment cost and contributes 160% to the total fund size. Moving on to Fund 2. In the pharma side, Brighton stands out as a high-end specialty API company. In the device side, Xilox is a leading vascular intervention device company. The total sector investment here is around 100 million, making up 37% of the fund. We have executed 9 deals with 6 IPOs. The sector-only DPI is around 150%, and the fund contributing percentage is 60%. For Fund 3, its investment period runs from 2020 to 2023, facing challenges from a competitive market and high valuations. HLC invested Novast, a top-tier specialty formulation company with over 120 million revenue and very high profit margin. The company is currently undergoing IPO review and aims to achieve Asia IPO in Q1 next year. In device side, we invested in Weigao Blood, the blood purification leader in China. The company has been successfully listed in first half this year in Asia. The total sector investment for Fund 3 is 180 million, including our public portfolio, representing 46% of the fund. We have done 9 private deals with 1 IPO and 2 filed. The DPI plus liquid share stands at 43% of the sector investment cost and contributes around 20% to our total fund size. We are confident that with more IPOs expected within the next 6 to 12 months, our DPI performance will experience a substantial increase. Finally, regarding our current Fund 4, is still in the process of deployment. HLC invested Viva Biotech, a world-leading drug discovery CRO. In the device supply chain, we invested in an AI plus component company, Fully Motor, with 80 million revenue. The total sector investment is around 210 million across 14 private deals and including public portfolio, accounting for 60% of current fund invested, and will be near 50% after the whole fund fully deployed. We have secured 1 IPO, 1 filing, and expect more companies to file in the coming 12 months. So this figure clearly demonstrates the strength of our supply chain investment strategy. We are confident that this sector will provide our fund with robust and reliable cash returns within a foreseeable time frame. HLC team is making a significant impact by assisting supply chain portfolios to restructure their business and drive steady growth, even in the face of geopolitical risk. Take Hongjin, one of our portfolio companies, as an example. It's a hidden champion in RNA raw material supply and a leading CRDMO in the world. We have assisted it in adopting a global legal structure with its headquarters now in Singapore. We also supported the company to build factories in Hungary, diversifying production and reducing risks. Moreover, we have brought in top talents and strengthened overseas BD teams to expand its global presence. We have connected it with Chinese pharma and biotech firms as the new clients, capturing more local market opportunities. Hongjin has maintained strong financials, achieving a remarkable 27% net profit CAGR for last 5 years. The exceptional resilience of Chinese supply chain companies has been clearly evidenced in multiple cases. Take Wuxi AppTec as a prime example. In 2025, its year-to-date net profit has surged by 43%. Specifically, the CDMO segment has experienced a 30% growth, while revenue from US market keeping increasing by 32%, both outpacing the overall revenue growth rate. Farmero, our portfolio, China's second largest CRDMO, also demonstrate resilient growth, with the bottom line for this year to date increasing by 32%. B1, China's leading biopharma, almost doubled its net profit for the year to date. United Imaging, our R&D fund portfolio, and the top medical imaging company in China, has achieved over 60% net profit growth this year. So I believe our key portfolio companies can learn from these excellent players, leverage their strengths, and mitigate geopolitical risks. Moving to HLC's pharma supply chain investment strategy, we are shifting from simple growth capital to strategic transactions with significant enabling services. In our Fund 1 and 2, we adopted a simple growth capital strategy. For investments like Wuxi AppTec and Farmero, we took minority stakes. As financial investors, we had relatively less strategic influence, primarily providing capital to support their growth. As we moved to Fund 3 and 4, our strategy evolved towards significant minority or co-investment. We targeted hidden champions and pursued strategic transactions with substantial value add and HLC ecosystem synergy. Take Novast as an example. It's a leading high-end, sustained release formulation player. We led the recap round with a 120 million investment and secured a board seat. Our strategies included implementing ESOP, referring a CFO, and introducing R&D collaboration with other HLC portfolios to create the synergies. Another case is Viva, a world-leading AIDD and SBDD CRO. We provide a pipe and a spin-off financing with over 200 million. We optimized its operations to improve margin. We also refer deals in both directions. So in conclusion, our strategy in supply chain shifted to not only provide capital, but also offer strategic support, enhancing the value of our investment and creating a more integrated HLC ecosystem. Here, I want to present a case study on Viva Biotech to further demonstrate HLC's strategic investment approach. Viva Biotech is a hidden champion in this industry. It holds a strategic position in structure-based drug design market and provides one-stop services. By combining AI-driven drug discovery and structure-based drug discovery, Viva drives innovation. It supports over 150 projects for more than 50 global clients, enabling 30 to 50% faster discovery and up to 70% cost savings. Now let's delve into the transaction. In 2023, Viva Lisco's shares were under distress pressure from impending loan repayment and weak Hong Kong capital market conditions, while its P&L remains healthy. The deal size was substantial, with a 210 million round, and HLC co-led together with our LPs. The deal structure included a 60 million PIPE to capture the share upside, along with a 160 million spin-off financing for the CRO segment, featuring strict downside protection and a future A-share IPO upside. After the investment, we have created a significant value add. We assisted in bank loan refinancing, optimized the CRO segment's operation efficiency, and introducing new customers. The results are positive. Since the PIPE, the share price has increased by 25%, and the CRO net profit grows at 17% CAGR. Moreover, we have achieved HLC ecosystem synergy. HLC refers 5 portfolio companies to Viva as potential new customers. Viva, in turn, refers a biotech client to HLC with a $5 million investment. Also, Viva participated in HLC's biotech incubation fund as an LP. So this case demonstrates HLC's ability to identify hidden trampolines, execute strategic transactions, create post-investment value, and build a dynamic ecosystem. Now, let's move on to device supply chain. We have invested around $200 million with 8 IPO exits, including Myray, Weigao, Gosh, Xilex, the leaders of various device segments. In this sector, our strategy is diversifying from pure domestic replacement to growing cross-border and AI plus elements. In Fund 1 and 2, our primary theme is China domestic market substitution. We aim to capitalize on domestic substitution opportunities like Myray by displacing imported products from companies like GE, Philips, and Siemens in China. Additionally, we are leveraging policy tailwinds to gain advantages from China's national volume-based procurement for public hospitals. Our investment in Xilex is an example of this approach. Moving on to Fund 3 and 4, our focus shifts towards cross-border and AI plus elements. For cross-border investments, like Cyphery as an example, it generates over 80% of its sales overseas and achieves annual growth of more than 30%. The company offers a highly cost-effective supply chain solution for developing countries and integrates e-commerce AI intelligence. In the later part, my colleague Emery will share more about our overseas collaborations with China's device supply chain. Furthermore, we are actively investing in cross-AI and AI plus elements. Tongya is one such investment, serving 2 application markets. The ultra-fine Cooper conductors applies in both medical device and AI electronics, while also being an upstream supplier for next-generation AI infrastructure. HLC is also supporting Tongya in building a factory in Thailand to boost its cross-border manufacturing capabilities. In the later session, my colleague Han will elaborate in detail about our cross-AI components and applications, investment, and synergies. Here, I will also just present a detailed case on Cyphery to illustrate HLC's strategy in the device supply chain. Cyphery is a leading dental device manufacturer with a strong presence in over 100 countries, generating over 80% of its revenue overseas. Founded by ex-Myray professionals, the company boasts exceptional manufacturing and SKU expertise, along with technologies that outperform many multinational competitors. It keeps developing and innovating dental device products such as sensors, oral scanners, and CBCT, integrating AI tools while providing competitive price and excellent customer experience. HLC was Cyphery's first investor in 2021 with an investment of $30 million. Subsequently, Hongshan joined during the A+ round. The company plans to launch an Asia IPO in 2027 when it grows to a larger size. Cyphery has achieved remarkable growth over the past 5 years, with a compound annual growth of 50% in revenue and 40% in net profit. This success comes from its smart strategy. By optimizing its supply chain and using innovative marketing, the company has successfully penetrated international markets and secured a competitive advantage. So Safari is a great example of how a well-planned global expansion supported by supply chain and AI components can drive growth. We are confident that there are more rising companies in device supply chain with cross-border and AI plus elements. So this session concludes our strategy in the pharmaceutical and the device supply chain. Next, I will hand over to Audrey, who will introduce HLC strategy within the consumption theme. Thank you.
Thank you, Harry. Good morning, everyone. My name is Audrey, and I'm glad to have the opportunity to walk you through our consumption theme today. To start off, let's first take a look at the overall performance of this theme. Our consumer wellness theme evolves with each fund, guided by our core competencies and methodologies. We have successfully delivered consistent returns since Fund 1. Let's break down each fund's performance and key portfolio highlights. Kicking off with Fund 1, our consumer wellness investments were mainly focused on healthcare services, including Chaoju Eye, the #3 ophthalmology hospital chain in China, and Wanzhong Brain, the #1 neurosurgery hospital chain in China. We made a total of 6 investments, amounting to $54 million, accounting for 31% of the fund. Among these 6 deals, there are 1 IPO and 4 trade sale exits, delivering a 115% DPI, contributing 34% to the fund. Moving to Fund 2, our strategy shifted towards branded products. Again, our portfolio featured industry leaders. We invested in companies such as Smoore, a global leader in electronic atomizer, and Norse, the #1 pet nutrition company in China. We made 8 investments in Fund 2 in the sector, totaling $98 million, making up 38% of the fund. In terms of exits, there are 1 IPO and 4 trade sales, and 1 company has already filed for IPO. In Fund 2, the consumption theme delivered a sector-only DPI of 188%, contributing 80% to the fund. So now in Fund 3, we invested in companies such as Xinyun, the #1 import supply chain enabler in China, and Saint, the #1 infant medical nutrition company in China. We made 9 investments totaling $113 million, representing 28% of the fund. Fund 3 has now just been in place for a little over 5 years, and the consumption theme is already delivering a DPI close to 100 and plus the liquid share of close to 100%, contributing 24% to the fund. Looking at the current Fund 4, we're shifting towards tech-empowered consumer wellness assets and investing in vertical leaders like Hissan Innovation, an AI-enabled home appliance company, and Matusela, a domestic leader in specializing food for special medical purposes. In terms of the current stats, we have made 9 investments so far, totaling $44 million, accounting for 13% of the fund. And 1 portfolio company has already filed for IPO. In summary, these figures underscore the resilience of HLC's consumption theme investments. This track record reinforces our confidence in the sector's ability to deliver sustainable and reliable returns to our investors. Now I'll dive deeper into how we have achieved this success. Our success comes from our ability to evolve. Looking back, we have structured our consumer wellness theme into 3 eras. First, the 1.0 era, cure and service. Our initial focus was on private medical services, primarily capturing the out-of-pocket healthcare spending from the middle class. And then the 2.0 era, brand products. We strategically pivoted to domestic brands, leveraging China's manufacturing supply chain, and consumer shift towards a value for money proposition of the local brands. Then the 2.0 Tech Plus era, this is our current focus. We're investing in cutting-edge technology for new consumer applications, aiming to enhance consumers' quality of life in every aspect. Crucially, every strategic decision we made shifting between these eras was carefully researched, planned, and decided. This was based on our rigorous analysis of the macro, the industry, and the companies, identifying where the beta and the alphas lie, and most importantly, leveraging our team's core competencies. We're a highly methodology-driven team, and you'll see that reflected clearly in the numbers and the case studies that we share. So now let me take you through this journey. Our Era 1.0 was centered on specialized healthcare services. The core investment theme was capturing the value from the middle-class medical service needs. The rising middle class in China weren't happy with the service they got at public hospitals, for example, the long wait times. And there was this growing demand for high-end specialized healthcare. We carefully selected the niche, high-margin, high-growth, specialized private hospital chains, rather than the large general hospitals, and we invest in the subsector leaders. For instance, we invested in Chaoji Eye Care. As I mentioned, it's the #3 ophthalmology hospital chain in China. Wanzhong, #1 neurosurgery hospital. And Melo Clinic, one of the leading premium dental chain. The deal sourcing for the first batch of deals was mainly through our industry connections. We were the first investor in all of them in Series A, which ensured reasonable entry valuations. This was a core strength of our founding HLC team. A lot of them came from CDH. CDH has already got a successful track record in healthcare services. So this was what we were good at. And this was also one of the reasons we chose to invest in this sector, because we only invest in what we know and what we are good at. Although these deals might not be the sexiest per se, but they all had successful cash exits. Chaoji had a Hong Kong IPO with 1.5x cash return. Wanzhong was a trade sale to New Hope Group with a 1.7x cash return. And Melo Clinic was a trade sale to another investor, returning 1.4x. Despite the solid returns we generated in Era 1.0, we made a crucial adjustment to our investment strategy around 2017. Why did we pivot away from services? So first, service model has a longer ramp-up period compared to products. Product models are more scalable and faster to ramp up. Secondly, China was changing. Starting around 2018 to 2019, the capital markets began to strongly prioritize technology innovation. As a result, IPO support for traditional healthcare service assets diminished significantly. We as the HLC team, we're always alert to those trends and we stay on top of that. Thirdly, the policy risk. The government's move towards a unified national payment system led to the creation of National Healthcare Security Administration Bureau. This introduced significant policy risk, directly pressuring the cash flow and profitability of the private healthcare service providers. Facing these three challenges, we recognize that the structural opportunity in private healthcare service was fading, and we made a timely and decisive switch in our strategy and moved into consumer wellness 2.0 era. Looking back at the exits and the returns in Era 2.0, we think we made the right decision. So we moved to our 2.0 era, brand products. What we call it, the domestic production capability pivot. In this era, Chinese brands are increasingly winning consumers due to their superior value for money propositions driven by the domestic supply chain. While our investment theme shifted from service to products, I hope you can see that our underlying methodology remains consistent. First, we invest in subsector leaders. Here, I have listed 3 example companies: North, #1 pet nutrition in China, Saint, as I mentioned, #1 infant FSMP brand in China, food for special medical purpose. S'more, the #1 electronic atomizer manufacturer in the world. Secondly, similar to 1.0 era, we were early investors in these deals, which allowed us to enter at favorable valuations. Our team became more established, and in that environment, we have proactively adopted a deep research-driven methodology to identify the underwater industry leaders. Both of these early stage deals, Norse and Saint, were sourced through industry research. And for S'more, although it was a pre-IPO investment, it was the company's first round of external financing. That being said, for growth equity deals, we invest for visible exit routes. And this is what we call it a barbell approach. For our exit strategy, just like Era 1.0, we rely on both IPO and trade sales. As of now, Norse is partially exited and marked at 4.9x. Saint is also partially exited, marked at 2.4x, and is lining up for Hong Kong IPO right now. And S'more has fully been exited, delivering a wonderful 7.2 return to our investors. Moving forward to today, the landscape has changed again, and this is why we have transitioned to the consumer wellness 2.0 tech plus era. After 30 years of development, China is consistently producing consumer products that offer both high quality and low cost as a global manufacturing powerhouse. And at the same time, China's technology is now world leading. It is no longer just about cheap manufacturing. It is about world-class high-tech products, yielding premium brands like DJI, which are competitively worldwide at premium prices. Finally, like ChatGPT in the US and DeepSeek in China, many black tech, so-called, has started to make real impact on everything, and very importantly, on consumer applications. These trends confirm our investment direction. The future of our consumer wellness strategy lies in technology-enabled wellness enhancement, as only companies with technological barrier will be able to sustain their margins. Now, in this era, we're witnessing the rise of high-tech Chinese consumer brands, such as DJI, Insta360, and Bloomage, Huaxi Shengwu. Like Stephen has just mentioned, we are observing cutting-edge technologies in AI and biotech. We're influencing consumer wellness worldwide. In this environment, we're investing in these technology-backed assets to service individualized wellness needs, covering beauty, covering nutrition, and lifestyle improvement. So let me first talk about what we have invested in this era. I have listed 4 examples here. Methuselah is an emerging domestic leader in food for special medical purposes. CellArc is a leading anti-aging technology company in Korea. And Terran is an AI-enabled stroller company. Hisan Innovation is an AI-enabled home appliance company. What you can see in common is that all 4 deals that we listed here possess technology barriers, applying technology to serve consumers' personalized wellness needs. We're now also investing in the new generation of leaders. These are highly educated, young, and ambitious founders. In some cases, they are already second-time entrepreneurs who have already achieved success once, and now it's their second time or third time to raise another startup. And we didn't really see that a decade ago. And as a research-driven team, these projects were sourced through our deep research or industry connections, just like in Era 2.0. And our investment strategy follows our proven methodology of the barbell approach. We invest in the 2 ends of subsector leaders. We get in early, such as Methuselah Series B, CellArc Series A, Terran Series A, which were identified through our sector research. Terran is now already planning for its next round of financing. Hisan is not an A round, but it's more mature and stable, and it still has a very high top-line growth rate. It is planning to apply for an IPO in 2 years. Next, I'll walk you through 2 investment case studies. The first one is CellArc. It is a perfect example of how we created a multiplier effect of our cross-border synergy. It is headquartered in Seoul, a leading anti-aging technology company founded by the legend of medical aesthetics in South Korea. We sourced this deal through our deep sector research, thanks to our on-the-ground Korea team. We invested $3.5 million in Series A round as one of the first institutional investors, alongside KBIC and B&H Investment. And our planned exit is trade sale in 3 years. The founder, Dr. Moon, is a second-time entrepreneur. He founded a medical aesthetic company called Hugel in 2001. Hugel was later acquired by Bain Capital for $1.6 billion in 2017, and then later acquired by a consortium led by CBC and Mubadala in 2021 for $2.9 billion. After successfully exiting his previous venture, Dr. Moon realized that retirement wasn't for him. So he founded CellArc in 2023, aiming to build another medical aesthetic giant in Korea. The core technology focuses on next-generation formulation and advanced rheology. The calcine utilizes an engineered advanced matrix with cross-linking for superior structural support, and it is the only product in its class that is capable of in vivo degradation via calcium binding. The PLA promotes cell penetration and superior collagen generation and offers significantly reduced inflammation compared to its fellow products and competitors. In terms of HLC's ecosystem synergy, our role extends beyond providing capital. A key part of our value add is to assist CellArc to enter into China. At the same time, CellArc introduces new proprietary deals to us. We're currently advancing 1 deal in our pipeline. In short, we're investing in what this country is best at and bringing the technology back to China to help to expand the Chinese markets. The second case that I want to talk about is Strut, that you have seen earlier today. And for those of you who are joining our portfolio trip tomorrow, it's this first company in the afternoon session. First, some excellent breaking news. Strut's flagship AI-enabled wheelchair has been announced as the Best of Innovation 2026 winner at the CES Innovation Awards last week. The team sourced Strut through industry connection and invested $2 million in this pre-A round, with co-investors including Meituan and HKIC. Our exit plan is IPO or trade sale in 5 years. Strut possesses world-leading technologies across sensors, algorithms, and hardware. When users drive the wheelchair, the co-pilot technology perceives the full complexity of the environment, automatically adjusting while driving to prevent collisions. Users can direct the path using voice commands. Crucially, the co-pilot is supported by LiDAR and ultrasonic sensors, which Strut is the first one in the world to introduce and to integrate technology into personal mobility device. In addition, the smart wheel system provides a more controlled, more comfortable, and highly efficient riding experience, even in rough environments. Behind these innovations, we're investing in the founder. Dr. Han is an exceptional leader with spectacular tech backgrounds. He is a physics Olympiad and he got his PhD at UC Berkeley. After his graduation, he started his career at the Honeywell Advanced Technology Lab in Silicon Valley. And after he returned to China in 2017, he joined BJI, where he was quickly promoted to the senior member due to his top performance in the company. And before founding Strut in 2023, he was managing 2 core technology departments, and there was over 200 people working under him. We anticipate rapid sales growth following the product launch next year, aiming for a revenue target of $150 million in 3 years. So bringing it all together, our strategy in consumer wellness is built on 3 core competencies that define how we operate and how we consistently deliver results. First is our interdisciplinary knowledge. Our approach is built on a synergistic edge, combining deep healthcare know-how and technology expertise. We believe that technology barrier is now fundamental to any future consumer healthcare investment that we make, and ventures that lack these cannot sustain their margins. Therefore, tech and innovation are mandatory in everything we invest now and going forward. This focus leads us to invest in areas like AI-enabled personalized applications. A unique advantage we possess is our on-the-ground teams in Korea and Japan, which provide an edge in both deal sourcing and ecosystem value add. Our second core competency is our battle-tested methodology, which has remained consistent across all three eras, our barbell approach. This means we strategically avoid the crowded intermediate grounds. One end of the barbell, we focus on early-stage investments. Here, we use proprietary research to identify underwater deals long before others see them, ensuring a low entry valuation. On the other end, we target growth stage companies, the mature industry leaders. This provides the portfolio stability and our exit visibility. Underpinning all of this is our strict investment discipline. We stay disciplined by investing in only what we know and what we are good at. We're highly valuation sensitive across both entry and exit. Finally, we exercise discipline in capturing the optimal exit timing to ensure we deliver strong returns to our LPs. In short, we're a team with clear methodology and tactics, and we look forward to continuing to deliver strong and consistent returns to our investors in this 2.0 Tech Plus era. Thank you very much, and I'll pass it to my colleague, Jimmy.
Thank you, Audrey. Good morning, everyone. My name is Jimmy, and within the next 20 minutes, I'll be walking you through our investment strategy. Our investment strategy and also performance for the biotech sector. So as many of you already know, HLC started investing in biotech sector upon our inception. Within the last 11-year journey, we actually made 297 million total investment into 41 biotech deals across 4 USD funds. And we have already exited 9 deals out of these 41 deals, 6 IPOs and 3 M&As. Through these 9 deals, we already returned $257 million back to our LPs, and we still have $172 million in liquid share. If we were to sell this liquid position today, we were able to return 1.4x DPI to our LPs. That means if you put $1 into each of our 4 USD funds today, you are well in the money. And plus, we already have 4 IPOs and 2 M&As in progress right now, and hopefully by this time next year, next AGM, we will be able to bring you some new and exciting news again. And on the right-hand side here shows you the very high-level overview of this 41 deal biotech portfolio. We purposely build a very balanced portfolio against modality and also geography. Modality-wise, 2/3 of this portfolio is put into small molecule and large molecule. As you may know, these 2 modalities are very mature with lower technical risk. It's more about the target selection and execution. And 1/3 of this portfolio was put into emerging modalities such as siRNA, CGT, etc., and which comes with higher risk but also higher return as well. And region-wise, the majority of the deals are within China, but we do have a very meaningful exposure to out of China, and especially in the US. And if you look further into this slide, on the left-hand side here, you can see the majority of our China deals are within the first two categories. That's because those are more for best-in-class assets, which China is really good at. Well, for the emerging modalities, those are mostly in the US. Well, US is the best at the innovation, the cutting-edge technologies. Next, I'll be sharing with you more details about the performance of each of the 4 USD funds for the biotech sector. So we fully recognize that the biotech sector is risky. So when we start in Fund 1, we only allocate 20% of the whole fund to biotech sector. And as we gain more experience and confidence in this sector, we gradually increase our exposure to 24% in Fund 2, 27% in Fund 3, and Fund 4 is still ongoing, but our target is about 30%, as Steven just mentioned. Deal number-wise, for Fund 1, only 6 deals, Fund 2, 11 deals, Fund 3, 13 deals, and Fund 4, even larger. We are very disciplined about the check size. So if you look at the average check size for each fund, it stays relatively stable between 6 to 8 million. That said, when we encounter a rare situation where we find a very capable, experienced team, promising technology, very competitive assets, we are willing and we dare to make larger bets, which is illustrated on top half of this slide. This top half shows you some of the largest bets within each of the 4 USD funds. I don't want to read the numbers, but I think the MOC number speaks for itself. Those large bets not only gives very great return for the biotech sector, it also becomes a cornerstone deal for the individual fund it allocates in. For example, for Fund 1, we have 6 biotech deals, and we have already 3 IPOs out of 6, and the DPI plus equity share for Fund 1 is actually more than 400%. For Fund 2, we have 11 deals. We already have 4 IPOs and 3 M&As already, and the DPI plus equity share is more than close to 350%. Fund 3 and Fund 4 is lagging behind a little bit. That's because the IPO market for both A share and also Hong Kong share was closed for 2 years. But now with the reopening of the Hong Kong exchange and also the reopening of the fifth standard for the A share capital market, and also with the booming BD activities starting from last year in the biotech sector, we do expect the DPI and the return from Fund 3 and 4 to catch up with the first 2 funds. So some LPs has asked us the question that the biotech sector is evolving very fast, it's ever-changing. How can you ensure that you deliver consistent results across all of these funds? I think the quick answer would be that, okay, we follow the technology evolution very closely, but that's not enough because every single biotech team in the world, investment team, will be tracking all the technologies. For us, I think HLC has 3 core competencies, or you can say key ingredients for our success. The number 1 is that we have a very carefully designed internal structure plus a very strategically cultivated external alliance. What I mean by that? Let me first start with our core biotech team. Currently, with our 10-year effort, we have built a team of 5 core members, focusing exclusively on biotech. All these 5 members comes from biotech, biomedical science background, received very elite education from overseas and institutions, and also have very rich and relevant research or investment work experience. And based on our own experience and our own interests, we divide and conquer the biotech space by each of us taking about at least 2 categories or 2 modalities to cover. But this is not enough. We don't really fight alone. HLC actually provide us with 4 different kinds of categories of support that empower us to deliver. The first support we gain from HLC is actually what Stephen mentioned, one for all and all for one. We closely collaborate with our supply chain team and also with our overseas team. So to ensure that we don't get blindsided by the sexy technology, we look at technology from a global perspective and from a supply chain perspective. So that gives us a more holistic view of the technology itself. The second support we received from HLC is that we have already developed a group of world-class advisors, including 4 scientific advisors, namely, for example, like Dr. Liu Xiaoling, the founder of Belfuse, and also 4 venture partners in the US, for example, Dr. Wendy Yang, former SVP from Roche. Those advisors are key opinion leaders or world leaders in their respective fields, and whenever we have a question regarding a new technology or a new emerging modality, we reach out to them, and from their guidance, we can avoid being misled by some fancy stories, or we can avoid missing out on some emerging critical technologies. The third kind of a resource we obtained from HLC is that the CRO strategic platform. We have already established 5 strategic partners with our CRO portfolios, and all of these portfolios, all of the CROs actually serves thousands of biotech clients worldwide. So those CROs, they are a great channel for both deal referral and also for data evaluation. Last but not least, as I mentioned just now, we have already built a portfolio of 41 biotech companies, and those portfolio founders, they themselves constitute a very broad network within the biotech space. So whenever we find a new founder from a new biotech, we look for help from those existing portfolios. And the chances are we will find someone who knows and who's very familiar with this new founder, and he or she will be able to give us very quick and also comprehensive and objective review or reference for this new founder. This really helps us with our due diligence process and increase our chance of success, and finally increase the return of the biotech portfolio. The second key success factor for biotech team at HLC is our clear investment logic and also very coherent methodology. So if you look into these 41 deals we already have in our portfolio, essentially they can be categorized into 3 buckets, or there are actually 3 things we're really betting on. They are the team, the data, and the technology. So first, let me start with team. What do I mean by team play here? Basically, we start out by identify a few modalities or technologies that's promising, that has a very high ceiling in terms of market need, and also has been somewhat de-risked. For example, siRNA, for example, ADC or bispecific. So we find this category, we think it's worth betting on. We go into the market, we look for every single team that's working on this modality and talk to them. And we try to find the best team out of it. What do we mean by best? That means the team needs to have the most experience, most relevant experience within this category, and we bet on them. And usually this is a best-in-class SS bet because the modality has already been approved by scientists. And because these companies more like a factory producing these new assets one by one, we don't really rely on the success of any single asset. The risk level is actually very low. The second type of companies we bet on, we call it the data play, which is very straightforward, easy to understand. we look for a particular disease or treatment area. We look at the current treatment and we look for any treatment that can beat the current best treatment. That's best in class treatment, and we bet on those. And since the assets number is very limited, usually 1 or 2, so the risk level is actually higher than the team play. The third category, we call it the tech play, which means that we'll go around the world and look for the most disruptive, cutting-edge technology that may change the world. And usually, this, as you can imagine, this is first-in-class assets, and the risk level inherently is very high. So these are the 3 things we bet on, and based on this logic, we developed a very cohesive methodology to work on those assets. For example, for sourcing, the HLC team research will be, of course, leading all the sourcing part for all of these 3 categories. However, we do rely on our resources for add-on value. For example, for team play, the goal is to find the best talent, and so we reach out to our portfolios for help. For example, one of our portfolio, GenFleet, the founder of GenFleet actually introduced the founder of Beltheus, Liu Xiaolin, to us, and that's how we became the angel investor of Beltheus. Again, for data play here, no one knows about assets data better than CROs and CDMOs, and that's why we reach out to our CXO partners for deal referrals. Just this year, our partner Viva Biotech referred Arthrosi, one of the best-in-class gout treatment developer, to us, and we made $5 million investment in this very promising asset. And thirdly, for emerging disruptive technologies, we reach out to our venture partners, and one of our venture partners, Wendy Yang, Dr. Wendy actually introduced Shenandoah to us early this year, which I will explain later in our case studies. Stage-wise, because for team play, we bet on people. We don't bet on assets, so we don't really need any data. So this can go as early as the company incubation. For data play, we bet on assets. We really need the conviction to ensure that this is the best-in-class treatment we can find on the market. So we need human data. Ideally, phase 3, but usually we can pull trigger if we are convinced by the phase 2 data. And for tech play, this is usually very early stage. There's absolutely no human data. We just go for animal data. As long as there's a POC, proof of concept, from animal data, we're good to go. Check size-wise, for the first category, team play, because the risk is relatively low, we're willing to bet large, and we are willing to make multiple bets. That's why actually you see on the previous slide, for companies like Kinter, GenFleet, Villa Vigo, we make multiple bets across our funds. For data play, because the mixed risk level, we usually bet a medium-sized check, and of course the check size can increase as our confidence level increase as well. Lastly, for tech play, because it's really high risk, we only bet once, and only bet very small, and we bet very early, and we shoot for the high return from this high risk asset. The exit is very obvious. For the team play, we go for A-share and H-share, Hong Kong Exchange IPO. For data play, it's more about M&A for the asset, and also maybe Hong Kong IPO as well. For tech play, we go for Hong Kong IPO, US IPO, or M&A as well. The third key winning factor for HLC Biotech team is our very systematic risk management or risk diversification across different dimensions. Number one is that we limited our number of investments within our comfort level. That's why you see, again, from Fund 1, we only have like 6 deals, Fund 2, 11, Fund 3, you have 13 deals as our confidence level increase. And also, again, the average check size, we're very disciplined, is between about 6 to 8. That's what we are comfortable with. Modality-wise, we started very conservatively that we only betting small molecule and large molecule for fund one. Those are the proven modality with very low technical risk. So that's where we started. For fund two, we try to test water. We bet one deal in emerging technology, still the majority in the traditional ones. And for fund three, you can see here the green bar here. We have 4 deals in emerging technology. That almost accounts for 30% of the whole US, for the whole biotech exposure. And for fund four, actually, the number is even higher for emerging modality. Stage-wise, our sweet spot is between pre-A to Series B. That's our comfort zone. But we try to get out of our comfort zone as we enter Fund 2. We made 2 investments in Series C and beyond for Fund 2. And for Fund 3, not only we made investments into Series C and beyond, we also put 2 deals, write 2 checks for seed level investments. So it's more comprehensive coverage of different level of assets. Lastly, for the geographic split, we're always China focused. That goes back to our belief in Chinese people and also our belief in our capability to produce or invent best-in-class assets in the world. Finally, let me give you 3 case studies here to help you understand more about the 3 plays that I just mentioned. The first one is Vivo. This is an antibody engineering platform. This is a perfect example for team play. The company is founded by Wuxi guru, a high-level executive called Dr. Li Jing. Dr. Li Jing led the DDSU, the Drug Discovery Service Unit at Wuxi Biologics with more than 200 employees. And he oversees or accomplished more than 300 research and development projects, and he is responsible for more than 2.6 billion US dollar transactions of licensing. So we get to know this deal through Steven's connection, and we really like Dr. Li Jing. We believe in his capability of producing world-class assets. That's why we led the angel round investment of Vivo, and also we participate in Series A as well. Together, we put in 19 million US dollar and also 50 million RMB into Vivo. Currently, we are the largest institutional shareholder with 18% ownership. Even though the company is still within the early clinical stage, it has already accomplished 2 billion deals with value adds up to about 1.2 billion US dollar. We will continue to support and make investment into Vivo, and we really have very high expectation for this deal, and we believe this one will be another or even a bigger biothesis within our portfolio. The second example is called LongBio. This is a company that creates best-in-class IgE antibody. I know this sounds a bit technical, but you don't really need to know the details. IgE antibody is used to treat food allergy or allergic asthma, etc. Currently, the best drug or best IgE antibody on the market is called omalizumab. This drug, this single asset sells or contributes about 4 billion in revenue every year. So it's really lucrative market, really highly solid assets. The inventor of omalizumab actually is not very satisfied with his own invention, so he founded LongBio and tried to make an even better version or best-in-class IgE antibody to beat his own assets, and that's actually he did it. From a phase 2 trial, LongBio's assets actually beat omalizumab in efficacy. It has much better efficacy, and also because of the longer half-life, the injection interval for patients is actually higher, longer. So that requires less injection, and the convenience is actually much higher. So this is really a best-in-class IgG antibody on the market. And we get to know this deal through Dr. Xue's research, and we co-led Series C with Jimmy Venture. We put in $4 million US and 37 million RMB, and currently we own about 33% of the company. The company is moving really fast. Actually, it filed for Hong Kong IPO 2 months after our investment. And hopefully we can bring you some great news in our next AGM about the IPO. The last case study is called Shenandoah. This is oncology biotech. The description here is a bit complicated. So as you may know, currently most of the oncology or cancer treatment on the market is aiming at attacking the tumor externally. Two very senior professors at Stanford University find a way to trigger tumor cell self-destruction internally without touching on or impacting healthy cells. So this is a brand new mechanism to attack tumor, and if successful, this will completely change the treatment paradigm for cancer. We get to know this deal through introduction of our venture partner, Dr. Wendy Yang, and we participate this angel round of this deal, which is led by a top US VC. We put in 2.5 million, and we now own about 7% of this just emerging company. And if successful, again, this will create very lucrative return for our biotech team. So that's all I want to share for the biotech sector. I hope you find this information helpful. And if there's any further questions, happy to talk with you after the meeting. And next, let's welcome our colleague, Emery. Thanks.
Good morning, everyone. My name is Amrit. I'm from our growth capital investment team and also covering our Southeast Asia investment. Today, I'm going to share with you HLC's overseas investment strategy and synergy. Our overseas investment strategy has evolved in the past 11 years. And this chart simply tells our story in a simple way. We started investing overseas since our fund 1, 10 years ago. We were quite focused on one sector, biotech only, and only in the US. Our logic was quite straightforward and simple. We do believe science is universal without geographical boundaries. So we go to the source of the most cutting-edge innovations. And going to Fund 2, with our confidence grew, we slightly increased our exposure to around 13%, and we made 9 overseas investments in our Fund 2. And 5 of them have already exited with pretty good DPI. Going to Fund 3, you might notice a dip to 8%. That's because of the COVID pandemic, lots of travel restrictions. So instead, we decided to double down our best existing deals in China. And now is our current fund, Fund 4. We're talking at around 22 to 24% exposure. And we're applying a 2-pronged approach. As you can see, one prong, we still stick to early stage biotech in the US. We remain focused and consistent. And the other prong, we have expanded to our neighboring Asian countries like Japan, Korea, Indonesia for supply chain and consumer. I'm sure a lot of you might be wondering why Fund 4 for expansion. Simply put, we think it's the right time. As Stephen mentioned, in the era of deglobalization and geopolitical uncertainties, we see a lot more and more companies are expanding overseas, and they're trying to establish overseas manufacturing capacities. And as a fund, we have deep dived into China healthcare and consumer in the past 10 years. We have built a network, we have established all the resources, and now I think we're ready for this diversification. So in summary, our journey has been from small and focused to now strategically diversified with a two-track strategy. So what makes HLC different from other funds investing overseas? Our secret sauce is HLC's well-established healthcare and consumer wellness ecosystem in China. As you can see from those gray boxes, we have invested 16 biotech deals, 14 CXO deals, 20 device deals, 26 consumer deals. This is not just a list of investments. That's actually our powerful network. As you also know, we're also managing 4 R&B funds, and that makes our network even bigger and stronger. So coming back to our innovation theme, as Jamie just introduced, we have a quite strong biotech investment team with solid understanding of science and insights into unmet medical needs. And behind us, we also have a very strong CXO network. So this allows us to identify key global trends efficiently and allow us to assess these opportunities rigorously. And the other way around, we can also leverage our CXO services to our overseas biotech investments. And when it comes to supply chain, I'm sure you guys know we have invested the best medical devices and pharma companies in China with access to the top-notch technologies, to the most advanced manufacturing capabilities. So for example, when in Indonesia, we bring these top Chinese companies to the country to facilitate their technology transfer, to help them localize their manufacturing. And the other way around, for our Indonesia portfolios, we help them to get these China resources and also help them to get a new growth engine. Last but not least, for consumption, we really leverage our commercial infrastructure of our China portfolio to act as a go-to market bridge for our overseas companies entering into China. And for example, in Japan and Korea, those countries have quite limited, market size. So Japanese and Korean companies, when they enter the China market, we're here to help. And also for our Chinese portfolios, like our portfolios in Korea, it's a CRO, and our portfolios in Japan, it's a marketing platform which can help our Chinese companies to expand market over there. So in simple terms, we're not just financial investors. We are strategic partners who can bring real and tangible network to the table. And having great strategy isn't enough. We need discipline. So this slide shows our internal rules of the road, what we do and what we don't do. So first, 2 things we avoid. We avoid unfamiliar sectors outside of our expertise. And second, we avoid spreading thinly across scattered geographies. So we have focused region and we have focused areas. Then move to the right, our positive playbook. In the US, we play in VC stage. Like we mentioned before, very early stage cutting edge technologies. And with the focus area in Bay Area, in Boston, where talent and technologies gathered. And our primary sourcing method is from our CXO partners and our venture partners on the ground. And when it comes to growth stage in Asia, for supply chain and consumer, we target at A round to B round in cities like Seoul, Tokyo, where we have offices already, and sometimes we fly to Jakarta. For our primary sourcing method, is from our portfolio referrals or our trusted local partners. In execution, we have clear methodologies. First, we avoid passive desk research, and we always go to our CXO networks for reference. There's too many deals, we cannot go deep dive to all of them. So we have to be selective, we have to be efficient for overseas deals. And second, we always avoid chasing overheated deals, and we're always sensitive on valuations. Our execution musts are simple. We try to source by leveraging our trusted referrals. We always partner with our local networks. And third, we always try to actively support our portfolios by leveraging our ecosystems. And our financial discipline is also very strict. The single ticket size has to be less than 2% of our fund size, and our total overseas exposure is capped at 25%. So these methodologies and principles allow us to capture overseas opportunities while strictly controlling our risks. And then let's move from theory to practice. Here are 3 examples showing how our strategy works. First, Arthrosi, a US biotech. It's a very classic data play deal like Jimmy just briefly introduced. So our biotech investment team did research on gout disease, and they were looking for the best-in-class asset, and they surprisingly found it's Arthrosi. And interestingly enough, we identified Viva is the incubator, CRO, CMO of Arthrosi. And as you already know, we're the significant investor of Viva, so easily we'll get the referral and we will gain the trust from the company. And so in the most recent run, we became the largest external investor of Arthrosi before its potential M&A. And second, Tawada Healthcare, the Indonesia largest medical device distributor. We recently co-invested with IFC. This is a classic HLC value add. So we played matchmaker here. You can see those big names, Wigao, Mindray, Yuwell, the leading medical device manufacturers in China. So we referred these big names to Tawada, and soon after, they started collaboration. And it's beyond the traditional model of distribution. You know, for example, Wigao is even doing OEM for this Indonesian local distributor for some consumables. And they're even forming a JV for Wigao in Jakarta to establish an overseas manufacturing capacity. Last but not least, Ultrasocial. It's a Japanese e-commerce enabler funded by the Japan X TikTok Experience team. We recently co-invested with SBI, a Japanese local VC. So it's also a typical HLC value add. We referred our Chinese portfolios and our Korean consumer portfolios to Ultrasocial for them to easily enter into Japanese market and for further expansion. So as you can see, different companies, but the same pattern. We source these deals from our trusted networks, we execute with discipline, and we achieve synergies within our ecosystem. So to wrap up, HLC overseas strategy is built on a clear evolution with our unique China healthcare and consumer ecosystem, and execute with discipline and with a proven track record. Our goal is to really maximize the synergy among our China and overseas ecosystem and eventually bring good return to our investors. Thank you.
Hello, dear investors. I know it's near lunchtime, so I'll make it quick. My name is Han. I'm from the AI Plus team. It's my great honor to introduce our cross-sector strategy of AI Plus opportunity and synergy. Before going into details, I would love to thank my colleague, Aaron, Austin, and Shane. The industry knowledge and news coverage is a team effort. The reason why I'm standing here today is because I won our firm-wide weight loss contest last year. So next year, it might be Aaron or Austin to stand here. Depends on what little contest we have. So let's begin. It has become a global consensus that AI will profoundly transform productivity and human lives. We are seeing national key strategies published by both China and the US. We are seeing emerging large companies like DeepSeek and OpenAI. We are seeing increasing AI IT spendings. So we think we are at the very beginning of this AI supercycle. If we refer to the internet and mobile internet era, each supercycle always starts with a breakthrough technology, which is marked by ChatGPT this time. The next phase will be a heavy capex phase with a focus on infra. Tons of money are spending on GPUs and data centers this time. The next phase will be an application phase. So we think right now is a good time to invest in AI plus opportunities. Among the abundant opportunities, we think there are three things related to HLC USD fund. AI plus consumer applications, AI plus healthcare and science, AI plus robotics. So firstly, since 2021, we started to assemble a diversified AI team. We have seasoned leaders like Aaron and Shane, who have been with the firm 10 plus years. They migrated from healthcare team to guide the new team. We have new AI dedicated talents to enhance our capabilities. Me myself joined the firm in 2021 with a focus in manufacturing and robotics. Marina joined us in 2022 with a focus on AI infra. Austin is a great addition to the team. He came from China's first AI giant, SenseTime, with a focus on AI and robotics. We also cultivate junior talents like Rainy, Nico, and Serini. With the team being built, like Stephen mentioned earlier, we didn't start the investment in AI plus in USD fund first. We began our exploration with our RMB funds since 2022. By far, we have 14 deals with a total amount of 604 million in RMB. These deals are carefully screened and thoroughly selected after tons of research and news coverage. Similar to our healthcare construct, we have 9 upstream deals and 5 downstream deals. We have held more than 6 industry forums and networking events. Our healthcare portfolios like Viva Biotech and Pharmalon are empowered by AI. We also have portfolios like Engine AI and Spirit AI, who have gained more than 3+ markup within a year. So we have built our initial network and expertise in this area. So moving to 2025, we are more confident and comfortable in this sector. Leveraging our expertise from RMB funds and the methodologies from healthcare team, HLC began to invest high-quality deals in USD fund. By far, we have 8 deals with an amount of 38 million. Following our firm-wide investment themes, these deals also fall into the themes of supply chain, consumption, and innovation. We have 3 upstream deals. Many are upstream companies with strong market share, good financials, and clear exit. We have 5 downstream deals. Many are companies with good potential directions, strong team, and low valuation. In the following slides, I will use a few examples to further demonstrate our strategy in this sector. So, combining our RMB and USD fund, similar to our healthcare team, HLC is building an AI plus ecosystem in this sector and forge synergies. Taking our AI plus robotics subsector as an example, we have 8 deals by far. First of all, these deals only include the ones post-transactions. We are still working on building this ecosystem with more deals coming. Secondly, these deals are also a great example of our teamwork culture. These deals are done by the whole team, not by myself. On the right-hand side, we have 5 deals in RMB funds, mostly in 2024. On the right-hand side, we have 3 deals in USD funds, mostly in 2025. Regarding of synergies, a head form is used and referred by our portfolio Engine AI. Foley Motor is actually referred by our healthcare portfolio, Safari, and is partnered with Spirit AI and Robstrike. Toya, besides working with robots company, is working with our healthcare company, Maiji and Weiga. Next slide. Let me walk you through a typical upstream case, Toya. It's a deal we invest in Q4 2024. We co-lead with Matrix Partner, which we invested $5 million USD and 55 million in RMB. There are 3 points I want to highlight for this deal. Firstly, we found a unique insight that healthcare has certain shared upstream across AI and consumer wellness. Toya's products can be applied to multiple downstream applications like medical devices and consumer AI products. Secondly, for upstream companies, we want strong market share, good financials, and clear exit. Toya has decent financials with growing momentum, and it plans to file IPO in 2027 in A-share. And lastly, for downstream deals, for upstream deals, we normally select the top player in each sector. So next page, I will show you a typical downstream case, Karen. It's a deal we co-lead with Verizon and Sequoia China in Q4 2025, which we invested $5 million USD. It's the first e-stroller that is equipped with AI. There are also 3 points I want to highlight. First of all, for downstream applications, we will only focus on healthcare and consumer wellness. Secondly, for downstream companies, we want the team and the leader from tech leading firms like DJI, Insta, and Xiaomi. They have strong R&D capabilities, overseas experiences, and they can leverage Chinese supply chain. Lastly, for downstream cases, we normally prefer to invest in the first 2 or 3 rounds with a low valuation. To summarize, HLC has developed a set of investment principles in AI Plus investments. We will be China-focused. We will not invest overseas in this sector at this stage. We will fully utilize our R&D expertise, know-how, and network. Secondly, we'll only focus on healthcare and consumer wellness. We will avoid sensitive areas with potential political or regulation conflicts. The new themes will only be in HLC's familiar territories. Lastly, we will be product-driven. We will not invest in software or operational-driven innovation. We want products built on manufacturing excellence, real products with real needs. With these principles being built, HLC will deploy a systematic approach in these investments. Firstly, we have resources in healthcare and wellness. So we will leverage the interaction with healthcare. It is our unique edge in winning deals, which also allows us to source deals with shared upstreams across AI and healthcare. Then we have established methodologies. For upstream CXO type of deals, we want strong market share, good financials, and clear exit. For downstream, biotech type of deals, we want good potential directions with strong team and low valuation. We are teamwork oriented with a flat organization and solid execution. HLC encourages teamwork across sectors and levels. For example, for deals like Toya and Foley Motor, our healthcare team have provided great support. Lastly, we love to build ecosystem to forge synergies, which will bring out new deal sourcing and strategic partnership. So that's all for my part. Our AI Plus team will leverage expertise from our R&D funds, methodologies from our healthcare team, and HLC's core competencies to create values for our investors. Thank you all for listening. I'll hand over to Henry.
So our leaders have elaborated their strategies with supporting cases in each segment. I would like to summarize HLC's strategy again. Our approach is built on three core themes: supply chain, consumption, and innovation. Supply chain is consistently standing as cornerstone investment through our funds, focusing on strategic transactions that offer significant value add. We incorporate cross-border and AI plus elements to drive sustainable returns. Under the consumption theme, we are shifting from service and brand products toward technology-enabled solutions to introduce cutting-edge tech for new customer applications. Regarding innovation, we strive for a balance across modalities and regions to achieve outstanding risk-adjusted return. We are targeting three areas: the best team in chosen fields, the best data for treatments, and the most disruptive technologies. And across these three themes, we see substantial opportunities overseas by bridging global healthcare and wellness small and mid companies with China's growth ecosystem. We also integrate AI-powered products into the next generation of healthcare and wellness solutions, creating synergies that drive future growth. So this strategy has been well proved by our past funds, and its evolution has been well aligned with macro conditions and the technology trends. We are confident that with our dynamic team, we will continuously generate sustainable returns in the future. Last but not least, we appreciate the long-term support of our LPs. Your valuable feedback and consistent backing have significantly contributed to our growth and the successful implementation of our strategy. Thank you. Next, I will hand it back to Jay.
Thank you, Henry, and thank you all of our team. Now you have all heard about our strategy and the exciting AI plus opportunities that we just shared. You might be wondering, how can we experience this firsthand? Rest assured, tomorrow we have scheduled a full day of portfolio visits, take you to Shenzhen, visiting 4 of our most dynamic companies. In the morning, we will start with XTalPi, a leading AI-powered drug discovery platform and a close partner within the HLC ecosystem. In the afternoon, we will visit Heason and Terran, the very AI-enabled platform, AI-enabled consumer wellness company that our team just discussed, both from our USD Fund 4. And then we will conclude the day with Engine AI, a pioneering general intelligent robotics company from our R&D portfolio. On the logistics side, you have 2 options. Either you can meet us 8:30 a.m. at the hotel, or you can go directly to Shenzhen. It will be a fantastic opportunity to see the innovative technologies in action and feel the dynamic energy of these startup companies. And if you're interested and haven't signed up yet, please come see me during lunchtime. Understanding our strategy and what we plan to do naturally brings us to the future, our plan for Fund 5. So please allow me to take a minute to share with you our fundraising plan. As Stephen mentioned, our approach is to stay focused and nimble. To that end, we are targeting a smaller fund size of $350 million US. The terms will be consistent with our previous funds, and the strategy will be what you have heard today. A core focus on China while actively exploring cross-border synergies. We will concentrate on healthcare as a key sector while remaining agile to pursue emerging innovations. In terms of the stage, we will continue to remain predominantly in the less risky growth stage companies, with a planned increase in early stage exposure to capture the innovations at its core. Regarding the timeline, the data room will be available starting next month in December, and we will officially kick off the roadshow and due diligence process in January next year. Finally, we are targeting our first close in June to July of next year, and emails with details will come out at a later date. We sincerely hope to continue our successful partnership with you and look forward to connecting with you during the Fund 5 fundraising progress. Team, during the offsites, our recent offsite on the Kumano Kodo Trail. 30,000 days of life, be a tree, breathing storms and sun, leaf by leaf, twig by twig, until the sky remembers your life. We are extremely grateful for the journey that we have embarked on and the immense fortune of having you as our close partners on this path. Despite market turbulence, uncertainty, and hardship, HLC team will always brush off the dust, recharge ourselves, and press forward together. Thank you very much for your attention this morning. This concludes our firm presentation. And now it will be our lunch break. Please enjoy your lunch, and we look forward to seeing you back here at 1 p.m. Thank you very much.